investment advisors or broker dealers. We're just sharing ideas.
That is true. Just ideas. What are we talking about today, Dimitri? Can you remind me?
So we're going to talk about vertical spreads, call spreads, put spreads. I'll probably just, focus on one, but they're, mirror images of each other, but I'll explain that, right after we get started.
Awesome. Hope everyone had a great Mother's Day. Always big deal getting out with mom.
Yeah, definitely. That's why we pushed it one day later so everybody could enjoy their Mother's Day.
That is true. That's why we're here today, right?
Yep. That was great. We got to go yesterday see my mom. We haven't seen in a long time.
Yeah, it's
nice.
Moms doesn't work without moms. That's for sure.
No, definitely.
All right, let's. All right, we're about to go live. You ready?
Yep.
All right, we're here. Hey, everybody. Thanks for joining today's webinar. It is Monday. This is a Sunday webinar series, but we are going on Monday today because yesterday was Mother's Day. Hope we have a lot of moms on the show tonight.
Yeah, happy
behind
Mother's
me.
Day.
If you look behind me, I'm going to duck real quick. We already had the disclaimer up. There it is again. Remember, we are not investment advisors. Dimitri and I are just the creators of the Chameleon. Well, really, it's Dimitri to my right is the creator.
No, that's not true. Pretty much everybody here.
We have a great team who work hard, but no one works hard than the King Chameleon over there, Dimitri Pargamonik. He's a great friend and a great mind in this business. So, Dimitri, why don't you take this webinar away?
Thank you. Thank you. I really appreciate that. Let me just share my screen. I think last time that was one of the things that went wrong. So just tell me if you see my screen.
I do see it. I'm going to bring the chat up just so everyone knows. We have a question and answer section. Put any questions you have there. We will get to those at the end of the show. If you're on YouTube, because we do stream on YouTube Live as well, put it in the chat column and I will put it out there. I'm going to type something in the chat right now. Make sure, does everyone hear us? Everyone hear Dimitri and I? That's good to know.
Okay.
Yeah.
And Will, did you have a poll that you wanted to share with everybody?
I'm going to fire that poll up too. We have a poll. We're asking you if you've ever traded a credit or a debit spread, yes or no. Any question we ask is helpful, so please answer that poll. And wow, the poll's firing off.
Nice. Well, this helps us, know from where we should start and at what level we should be talking about. But really quick, while everybody's filling out the poll, the reason I wanted to bring up vertical spreads is because the most common things when I talk to traders, especially new traders, or even like people who have been around a lot, only focus on single options. So what you'll see is they'll start with the simplest thing is buying a call or buying a put, right? And when you're buying a call or buying a put, it is not that easy to make money doing that. It's probably much harder than a vertical spread. It's easier to understand, it's simpler, but it doesn't mean that's the best risk reward. The other thing I see is besides buying a call or buying a put is, and I'm going to move away actually from this screen. I'm going to go to my regular screen. So besides buying a call or buying a put, and this is just the options chain here, we could see the prices of the calls, prices of the puts. And well, let me know after the poll is ready, just give me like a breakdown of, how many people actually traded vertical spreads or not.
Well, it was 70% when I last had it up, and 70% have. So there's a lot of spread traders right now.
Okay, great. So, and we're going to do some screening for spreads, but really quickly, this is the thing that I see the most. What I wanted to share with people is that what you'll see, typically people they'll start buying either a call, they'll look at a call here, buying a put. And a lot of times what what will happen is that they don't even realize, they'll lose, like even people who buy calls, they see the stock go up, but they still lose on the call, and that's because the call, it's not just direction. You have implied volatility component to it. You have a decay component to it. So it's not that simple. Even if you buy a call and the stock goes up, and you won't necessarily make money. And the thing is, when you're buying options, not only do you have to be right in direction, but you got to be right in the magnitude of the move, and you also have to be right in the time frame, right? So if you're buying a call and that expiration expires in 10 days, and the stock doesn't do anything the next 10 days and it goes up after that, then it's too bad, your option has expired. So it's very difficult when you're looking at just buying calls or just buying puts. The other thing I see is people do the reverse, and what they'll do is say, I can't make money owning options, I'm going to sell options. And what they'll do is look at the options chain, and they're going to go to a low delta, and they'll say, I don't like to lose, so what I'm going to do is sell way out of the money options. So they'll go standard deviation, 2 standard deviation away. Everybody has their own methodology, 5 delta, 10 delta, because their opinion is, well, the further away it is, I'll sell it, collect the premium, and I'll do that over and over again. And if the stock drops, I don't care, I want to own it. That's the kind of the mentality. Of course, eventually the stock drops, they lose, they sell that put for maybe very little, 50 cents, $1, whatever. The stock drops so much that they'll end up losing like $10, $15. And at that point, the situation usually changes, and they might not want to own it. So the vertical spread, so the people who hang around kind of learn from those mistakes, eventually go to vertical spreads, right? They'll say, okay, let me spread out that. Let me do buying an option, selling an option. And they kind of figure that out. And then their success rate goes up. Once you start learning the vertical spreads, I think it's even a better way to start than just doing straight calls or puts. Even if you have to sit back and learn, it's way better to learn the vertical spreads than just go doing straight calls or puts. It's much harder to make money doing it that way. I'm going to close that poll. And one of the things that somebody told me, it was very interesting when I first went on the trading floor and said, Dimitri, I've been trading vertical spreads all my life. I love it. And he explained to me, if I told you, you could buy spread in 2 weeks, in a bellwether stock, or even in the SPY, that next 2 weeks, if the stock sits there or goes higher, you could get 20% return on your money, 30% return on your money. Even if you're wrong a little bit and the stock goes down, you could still make the 20 or 30% return in 2 weeks. And then it kind of started hitting me like, that's not a bit, you can't find a junk bond that'll pay that over a year's time. So in 2 or 3 weeks, taking like a bellwether stock like Apple or whatever, Microsoft, or even the market itself, and get those types of returns, that's incredible. And the great thing about vertical spreads is that your cash layout is not that big. It's not like when you buy Apple, you got to put up a lot of money to make 20%. The stock has to go up 20%. Here, you're putting up little money, and the stock really, as long as it just kind of sits there or trends higher, and that's your return. And I'm going to give you some examples now. There are call spreads and put spreads. And people ask, well, should I be doing a call spread or put spread? And initially, people start kind of doing the call spread because they understand it more. It's a debit, you're paying something. And the way it looks is kind of like this. You buy a call on one strike, right? That's what I'm doing now. And let's just take a look at this. You see, when I buy a call.
Hold on 1 sec here. Are you
Sure.
sharing something? Because right now we're still seeing your face.
Yeah, I think I'm sharing my screen. Let me do it again.
All right.
Let me know if do you see my screen?
All right. Yep. See it now.
See it? Okay. So basically right here, I'm just looking at this is the SPY options chain.
Perfect.
You would start out, right, just buying a call first, and then you're going to sell a call. But let's just take a look. So when I'm buying a call, here's what it would look like. The stock, it has to increase above here at expiration for me to make money. And there's a lot of risk. I mean, there's a delta risk, there's gamma, vega, theta risk. So there are a lot of risks to an option just besides directional. So you're carrying, an implied volatility risk, theta risk. So one of the ways to hedge it off, and this is what a lot of traders, especially professionals, they're going to hedge off their risk, right? They're going to spread out their risks. And one way is to say, okay, if I'm bullish, I'm going to do a bullish call spread. So I'm going to buy a call on one strike, and I'm going to sell a call on the higher strike over here. So this would change. So this is what I did. See, I bought a call, the 292 call. I sold the 296 call. I'm going to take a look at this. So over here, this is how it kind of looks now, right? That's how it looks. So I mean, I'm limiting my upside, right? But I'm also limiting my downside. And then this question comes up. Well, I don't want to limit my upside. I just want to buy the call. The probability of you buying a call and hitting the lottery is very low, right? Like how many times, if you're good at it and if you're good at spotting situations, maybe that could be explosive, but that game is you also have a lot of losses. But you're not going to see that. It's very hard to pick and time it where you're going to pick a stock where you buy the call and just, it's not going to go to infinity. Maybe it'll go 10%, 15%, but buying lottery tickets and thinking you're going to hit every time is impossible, right? So that's why the spreads are good, because you'll still get very good returns. So even here, you see that this here, if I'm buying it for 245, right? Here, the return is 155 bucks. That's not bad. What is that? 50% return, something like that on a risk of 245. So not quite, but like between 30, 40. So you could still make really decent returns, and you don't need these explosive moves, right? Because if you're buying a call and you're playing a lot, you need that explosive move. It's very hard to pick that up. But this is what a call spread would look like. And then, so a call spread is really a revert. If you do a put spread on those same lines, it's really just the mirror image. So instead of paying a debit, you're going to receive a credit. So the credit is the amount that max you could make, and then you're still stopped out on that credit put spread. So I'm just going to show you on that same line. See, so if I sell this put, right, I buy that put. Let me just remove these. So this is selling the put spread. So you could see it's a mirror image, basically the same thing, right? Instead of, so right now we get a $1.53 credit. That's our max gain. If we have to buy this put spread back, what is this, like the $6 put spread, then we would have to buy back if it goes below the 292 strike. But basically it's kind of the mirror image of the call spread. Why would you want to maybe do a call spread versus a put spread? The one thing about call spreads, and I kind of start out with put spreads, is that when you do it with a call spread, there's an early exercise component to it, especially around the dividend. So remember, like when you own options, you're not entitled to the dividend. And if your option is deep in the money and you want that dividend, you have to exercise that option, convert it to stock. When you own the stock, then you're entitled to the dividend. If you don't do that and you own that option, that dividend is gone. You don't get it, right? So you have to kind of remember that there's a dividend component when you're doing call spreads. And if you have a deep in the money call right before the exit dividend, that's something you got to remember to do. In the put spread, obviously you're not exercising your puts because you're exercising put, you're shorting stock. So you don't have to do that in a put spread situation. The other thing is, if you're doing a call spread for a stock that you actually have, let's say you own Apple, right? And you have long-term capital gains in Apple, but you determine you're going to do a call spread in it. If that call spread is way in the money, right, at expiration, you just let it go to expiration, your long side and your short side will both get assigned. But that short side, so you're buying the stock and selling the stock simultaneously with the option. The thing is, if you're sitting on the stock, depending what how you have it with your broker, they could look at that as a taxable event on your stock. They'll say, well, you sold your stock and bought it back. So you could give up that long-term gain. So you got to be careful with the call spreads. They're fine, it's mirror image, but just those couple things to keep in mind about the difference between call spreads and put spreads. So let's just go to a screener. We're going to screen out some put spreads here, unless somebody has like basic questions right now I could answer right before we go. Do you see any popping up, Will?
Nope, you're good.
Okay. So here, this here is a credit put spread screener, that I popped up, and I just put, anything next 30 days. I already just brought that up. So these are all the different stocks. It's scanning different combinations of put spreads, selling this strike, buying this strike. It's looking at the market prices, and it's getting a bunch of other data that we're going to discuss here. So here, when we, let me just go over what this means before I do a scan, because some people might be looking at it the first time. So here, there's a stock symbol, stock price, Microsoft. This is the Microsoft's market cap. This here, this is the credit. So remember, when we're selling a put spread, right, we're selling a higher strike, buying a lower strike, we're going to receive a credit for it. And this is the credit, $1.54 for this put spread. Selling $1.85, buying $1.80 put spread on May 29th. That's the credit. This is here, it's a theoretical value. I'm going to get into that. This is your theoretical edge. I'll get into that. This is your win rate. These are the deltas of the option. This is your max loss. So what does the max loss mean? That, well, if I get this is a $5 put spread. If I sold it for $1.54, if Microsoft at expirations below $1.80, doesn't matter if it's, $1.79, $1.70 or zero, I got to buy that put spread back for $5. So if I buy back for $5 and I initially received $1.54 credit for it, my net loss is $3.46, right? Buy back for $5, I received $1.54, my max loss of $3.46. This here is what it's doing is calculating your cushion. So to the downside. So we know that if you're selling a put spread, you're putting on a bullish type of outlook. You want the stock to go up because you're selling. Remember, you're selling a put at a higher strike than you're buying. You want the stock to go up. But in this situation here, what we see is this: that Microsoft here right now is $186.81. Right? If Microsoft stays above 185. Right? If it goes higher, it stays the same, or as long as it stays above $185, you're going to keep this entire credit, right? That's $1.54. If it goes below 185, right, it could still go below 185 by the amount of this credit, $1.54, right, until you break even. So that is kind of your cushion to break even. That's what this 1.8% is. It's saying that even if it goes against you the other way, you got about 1.8% until you start breaking even before you start losing money. So what is your return? What if Microsoft is just flat here, right? Like in the next, so this is May 29th. I'm just going to open this really quickly just to find out. So May 29th, there's 13 trading days. So there's 13 trading days to expiration. As long as Microsoft in 13 days, right, is above 185, your return on this spread is 44.5%, right? You're risking $3.46 to make $1.54. You made the $1.54, 44.5% return on that risk. That's in Microsoft. Okay, so that's what we're kind of like, that's all these explained. And now I'm not going to, unless there's more questions, I'm not going to get too far into details because I did a lot of videos on theoretical edge, theoretical value. But basically what this is saying is the following. Whenever you look at an option or a spread, right, it's not just, remember we talked about some people go way out of the money because all they're concerned about is like, I want a high probability of winning, right? So give me the lowest delta, 5 delta or whatever. So that's part of the puzzle, right? Like, and I explain it to people like this. Let's say we played a wheel, and I just had this conversation actually with somebody last week. I think it was on Friday or Thursday. And he was saying like, I just want the five delta, 10 delta. I'm like, okay, you could do that, no problem. But that's one piece of the puzzle. And I explained to him like, look, if we played a game and if I had a wheel, right? If I had a wheel with 10 numbers and I said any number from one to 9, doesn't matter, 1, 2, 3, 4, 5, any number from 1 to 9 lands, you win. I will pay you $1, right? Would you play that game? You have a 90% win rate. And he started thinking, he's like, well, and he was and I'm like, well, what if I told you that when it lands on 10, you pay me $100, right? Then it changed. And he started figuring out, right, it's about, well, what's the expected value? What's the expected value of this game or this trade? That's an important piece. And that's what the theoretical value is. That's the long-term expected value of this spread, right? So even if you have a high win rate, but if you're selling it, because in this situation we're selling it, if you continuously sell it below its expected value, eventually you're going to start losing, right? That's a negative edge trade. Just like you won 90% of the time, but every time you won $1. The 10% of the time you lost, you pay me $100. Well, eventually you're going to lose a lot of money, right? The more you play. So that's what the theoretical value is. It's looking at the historical stock returns in the last 6 years. I think we have it here. It might be set right now to 4 years. Let me just see what I have it set to, 4 years. So you could change it to 6 years or go to the options change, set it to whatever you want. But what it does is it looks at the historical returns of Microsoft over, the 13 days and how much does it usually move? And then it creates a theoretical value and say over a long period of time, this is the theoretical expected value based on the historical returns. Now, we do have a coronavirus situation here, and obviously that is not reflected in historicals. So you have to keep that in mind. The theoretical edge, that's basically just telling you the following, that historically, if this was the end value and you sold it for $1.54, and on average you bought it back for 91 cents, that on average, right, you would lose some, win some, lose some, win some. On average, your return would have been 18.2% based on today's price. 80.4% is saying that historically, if you did this trade for $1.54, 80.4% of the time, it would have ended up profitable. You would have been able to buy back for a little bit cheaper. Either keep the whole $1.54 or buy it even back for $1.51. It's just telling you how many times it would have been profitable. And you could open this up. It tells you the entire analysis here and all the data below and how it's done. But just for purposes of kind of going a little bit faster, and I did a lot of videos on this, I'm just going to move on to show an actual scan. So having said this, there are different ways. Now, everybody's a little bit different, right? Like some people might be more aggressive. Some people are less aggressive and they want a little bit more cushion. Some people are just looking for a high theoretical edge. So there's no one perfect way of doing it. You have all the parameters at your disposal, so you could trade based on your own personality here. So let's do I'm going to do an example here. First of all, let's scan initially. We just want positive, I already had this set, but initially let's just scan that we want to have some kind of positive edge. So we don't want a negative edge. So I'm going to filter out and say, initially, I just want to make sure I have some positive edge in my trade. And that's these here. So you could see Microsoft is popping up a lot because it has a bunch of different credit put spreads with positive edge. Now, and the reason Microsoft's popping up all over the place because it's auto sorted right now by market cap. So that's what we're seeing right now. So then next, we could go with win rate because some people, they want to just also not only have a positive, but they can't handle well, I don't want to lose 50% of the time and win 50% of the time, or I don't want to lose 70% of the time and only win 30% of the time, even though it's a positive edge trade. So then you could actually, if that's not you and you're looking for maybe like a higher win rate, you're okay with, given maybe less return, you could use that too and say just theoretical win rate. Historically, I want it above 70%. And you could kind of keep filtering that down using this these filters. And by the way, the reason I think also vertical spreads are important is once you get good at vertical spreads, you're going to be able to use a lot of strategies out there because they're a combination of spreads. You know, like a butterfly, it's two vertical spreads, put spread, call spread, iron condor, two vertical spreads. It's an out of the money call spread, out of the money put spread. So you'll be able to, once you get really good at it, you're going to actually open up a lot of possibilities for yourself. So over here, now I filtered out, you know, any positive edge, anything with historical win rate of 70% or higher. So here then you see we have Microsoft popping up a lot. So now I just want the best credit put spread by symbol, right? I don't want to see a bunch of Microsofts. I don't want to see a bunch of Apples. I just want to see the best. So then you have to pick the best by what. So given these parameters, let's just say, you know, I'm conservative. I want to see just the best downside cushion. You know, I think the market's I think it's going to go up, but I think there's a chance that it's going to get reversed for whatever reason right now. I'm a little bit jittery. Show me the best ones with these parameters, but the best downside cushion. So you just do this, show me best the win rate. Like this best return if here, best downside cushion. Sorry. So this is best by downside cushion. So we'll see so right now, what it's doing for you is besides doing all those calculations, it's scanning everything for you. You'll never be able to do this by hand. That's how powerful it is. Like, you know, you won't be able to do this by hand in your entire lifetime. So now this is what it found for us, you know, given these parameters, you know, for Microsoft, here's a 14.4% downside cushion. You know, this is the 160, 155 put spread for 186. So you could see how far away it is. For Apple, it's 280, 275, 11%. And these are kind of a little bit far away. So this is probably not that. So I would probably require a little bit more edge. Let's see if we require more edge, like 15% edge. So here we go. So at least 15% edge. And now we got these cushions here, 2.9, 3.6. Now, what if we just wanted the best? We didn't really care about downside cushion. We just wanted the best return if the stock's flat, like this. So then we go here, say, show me best return if stock is flat. Again, it's going to quickly scan all the markets out there for you, and boom, here, 50% return if the Microsoft is flat or higher at expiration. Facebook, 51% return if stock is flat or higher, and this is your downside cushion, 78% return for Alibaba. So that's how quickly, you know, you should be able to go in there and scan your spreads and just narrow them down. Now, these are all of them. I'm just scanning the entire market. If you wanted to look for, if you have your own watch list, you could do that in here and just pick by your watch list. If you want to do just stocks like in S&P 500, Dow Jones, you could do it that way. If you're, because remember, we're kind of bullish here. So here's another stock ideas. Like, let's say you're only looking for market leaders, and what market leaders are stocks that are the 25 stocks in the S&P 500 that are the most responsible for bringing this, or the best performers that are bringing the S&P 500 up. And the idea behind that is if you're bullish, you stick with the market leaders, because if the market leaders go, everything's going down with them anyway. Another thing, you could look at momentum stocks. You could look at, you know, different moving indicators, stocks that are like in an uptrend. So these are just based on moving averages where the stock is just crossing, you know, the 20-day, 50-day, 250-day, 20-day, and 50. They're all crossing in a upward momentum. So these are like the things that you could start using to kind of, besides filtering out good theoretical edge spreads, add a little bit of stock analytics to it. And these are just a little bit of the things that you could do here. And, I'll see if there are questions. I'll try to answer them. If not a lot, I'll go do another, perform maybe another scan.
All right. Well, we do have some questions, so let's get to it.
Sure.
See, we'll start with Tom Butler. He asks, could you contrast the benefit between doing a credit spread versus a debit spread?
So remember, a credit spread and debit spread, if you're doing a debit call spread, you could do a credit put spread on those same strikes. They're going to be mirror images, right? The two things that, though, when we're doing at least a debit spread on the call side, remember, you got to be careful with the dividend because you're going to have to exercise early. If you have a call that's deep in the money, you're going to have to exercise or you give up that dividend, so that you could lose a lot of money on that. And it could it could trigger, if you own the stock, it could trigger a capital gains tax. But really, you could just even compare the two because they're mirror images of each other. If you're doing a debit call spread, you could do the credit put spread on those same strikes. They should be mirror images of each other because what happens is if they're very mispriced, it allows you to create an arbitrage opportunity. They call it the box. I'm not going to get into it, but because of put call parity, if they're out of line, they shouldn't be out of line. If they're out of line though, then it creates an arbitrage opportunity, except only when there's an early exercise, like right before a dividend, or if it's very deep in the money and you need to exercise a put.
Great. Stephanie's asking a question, and you may have a different thought than me, but I'm thinking she's asking around just the option chain. But she says, I'm never crystal clear which strike / expiration to select. And as you always indicate delta, I often struggle to find where the chosen strike is indicated. Can you please mention on your show this? That's a question. And if there is a best practice theory about which series to choose.
Right. So in this example here, what this makes it easier is because you could actually scan it. So the delta doesn't really mean anything, right? Like when the way I explained to you the wheel, right? The wheel, when you win 9 out of 10, right? So 9 out of 10 times, so 90% of the time you win. It's not just that, it's a piece of the puzzle. So you can't just look at the delta and, think that that's great. I'm going to sell things 10 really far away. You kind of have to also look at the prices and like what the expected return is, because if you don't, you're going to fall into this doing maybe potentially bad trades, even though you might have a lot of frequency of wins. Just the amount of money that you're bringing in is not worth doing them. So you have to kind of take both those into consideration. That's why I showed kind of this example where you want to, see, well, what is the price of that spread? What's the frequency of wins, and take kind of, expand your analysis. I don't think you don't want to just look at deltas. It's not as simple as that. It's just going out of the money. It's just saying, I'm going to keep doing things that are just out of the money.
Gotcha. Listen, this is a two-parter from Ron.
Yeah.
It's in relation to the Microsoft example you gave earlier. So that's just to be aware of that. He's asking, what if this trade is the same trade with a similar Theo value over and over again every week? Will I be making, I guess this is relative to what the Microsoft example you were showing, an 80.4% profitable trade, which offsets of the losses, I'd be substantially profitable, right? Is what he's asking.
So now remember, it's a theoretical value using historical returns, historical stock returns, because that's all we have, right? So what it's saying is that what we think is that the return distribution, the stock return distribution, if it's similar to historical returns, that over time, this is what on average, this is how it's going to look. So it's an average. No, it's not. If you do it next week, you can't, it's like, flipping a coin. I don't know if heads or tails are going to, but heads or tails, it's a little bit easier that over a longer period of time, you think it's going to get back to 50-50. But historical returns aren't exactly like a heads or tails, because they could really be anything. It's a probability distribution. So think of it as there's no exact where you could say Microsoft in 10 days will be either up 5% or down 5%. We can't pinpoint it that way, right? So we look at a distribution of returns historically and say what does it tend to do? So here, you know what? Let's look at this one, Microsoft here. Maybe this will be a good example, actually. This might help you out. So here we see that here's Microsoft. This is the study, right? So we should just look at the study here, and I think this will make more sense. So I'm gonna
can you just show us how you got that again?
Yeah. I'm gonna close this. So you see here the analysis over here. We're gonna open up that analysis and just take a look at how we got there. Okay. This will make sense, because I think a lot of people think when you're trading options, it's like in absolutes, like there's something like where it has to be this, like a coin flip, but that it's nothing like that, because stock prices don't move that way. Stock prices could be anything, a week from now, but you're just looking at what do you think is likely going to happen. But let's just take a look at this example here. So this one is an Intel. Oh, wait a minute. This one's Microsoft. How did it change? Hold on. Was I looking at Microsoft before this?
You were, yep.
Let me see. All right, let me just do the Intel. I don't know what happened when I switched the screen. All right, do you see that right now?
Yeah, I see you went to Intel, yep.
Right, so here's the Intel situation here. This is Intel. We're looking at the June 5th 60 put. We're selling the 60 put, buying the 57.5 put, okay, for 84 cents. The stock is 60.10. So you could see here, Intel 60, 57.5 put, 84 cents. It's a $2.50 put spread. The stock is 610. There's 18 trading days to expiration. There's nothing here. We know these are all given to us, right? This information we know. This is given to us. So what else we know is this, that if at the end of 18 trading days, right, from today at expiration, at the end of 18 trading days, if Intel is below 57.5, right, if it doesn't matter if it's 57, 56, anywhere below 57.5, zero, that we have to buy this put spread, the 60, 57.5 put spread, we have to buy back for $2.50. Doesn't matter where we sold it, that's where we have to buy it back. So in other words, if from today's price, after 18 trading days, Intel drops by 4.3% or more, we have to buy it back for $2.50. If the stock stays above 60, or from today's price, negative 0.2% or higher, then we know that both these puts will expire worthless, and this put spread is worth zero, right? Stock 61 or 100, this put spread is worth zero. We also know this, that if the stock lands anywhere in between 57.5 and 60, so anywhere in this band between 4.3% to negative 0.2%, then this put spread will be worth anywhere between $2.50 to zero, depending where it lands. So if it lands at 59, that's $1 in the money, it will be worth $1. If it lands at 58, that's $2 in the money, it'll be worth $2. So anywhere in this band, negative 4.3% to negative 0.2%, it'll be worth anywhere between $2.50 to zero. So what we don't know right now, and this is the hardest part about trading options, what we don't know for sure is the probability of that happening, right? If we knew for sure that in 18 trading days, Intel is going to be below 57.5 or drop by more than 4.3%, if we were 100% certain, then we know this is going to be worth $2.50 in 18 days, right? If we are 100% certain that it's going to be 60 or above in 18 trading days, if we knew that, then we know this put spread is going to be worth zero. Both of them expire both puts expire out of the money. But we have no idea. There's no way, we don't know what's going to happen in 18 trading days. So what do? The next best thing, just like an insurance company will look at our data and say, okay, well, how often does this happen, right? Like, how frequently does Intel drop by 4.3% or more in 18 trading days, right? How frequently does it stay above negative 2.2% after 18 trading days? And how often does it land right in between this band? So since we don't know, we look at historically, how frequently does this happen? So here's the study here. This is the theoretical value of the spread. We use 6 years of data for an 18-day stretch, right? So over an 18-day stretch, how much does it move? And we exclude any earnings periods because obviously during earnings, the stock moves differently, right? It moves more violently. So since Intel is not going to report earnings between now and June 5th, automatically we exclude that. The machine does that for you. So this is what it found in 57 observations. So this is what we're looking at here. And the data is all here below, okay? So this is what it found, that the amount of times it dropped by negative 4.3% or more in the last 6 years, that happened 14% of the time. So 14% of the time, it would be worth $2.50. The amount of times it stayed above after 18 trading days, above negative 0.2%, that happened 65% of the time. So 65% of the time, both puts, theoretically, they would have been worthless. It would be zero. And in between, that happened 21% of the time for an average price of $1.14. So what do? Is we say, well, 14% times $2.50 plus 21% times $1.14 plus 65% times zero, your theoretical value or your long-term average value is 59 cents, right? In other words, if I did this spread historically over and over and over and over again, my average end value was 59 cents. I had to buy back for 59 cents. So if today I'm selling it for 84 cents, so historically, if I sold it for 84 cents and on average I bought it back for 59 cents, this is my theoretical edge, okay? So here's the data between April 14th, March 18th. That was 18 trading days. The stock went up 27.4%. This put spread would have been worth zero. Between March 18th, Feb 21st, stock was down 26%. This spread would have been worth $2.50. So it just keeps going back, telling you at each time how much it would be worth. Hopefully this helps. So what is this? So now we know. So 84 cents, if we sold it for 84 cents, we bought it back for 59 cents. That's like 25 cents on average. You buy back on that for 25 cents better. You're risking, right, $1.66. So you're risking $1.66, 25 cents. That's 15% edge amount on average you would have made based on over what you risked. 70.2% of the time, what this is saying is that historically, I'm going to bring this back up, 70.2% of the time, you would have been able to buy back for less than 84 cents. So here, zero, that's worthless. Here you bought it for $2.50, that's a loss. Here you bought it for $1.14, that's a loss. This is zero, $1.50, that's a loss, zero. So 70% of these observations, 69 cents, that would have been a win. 70% of the time, what this is saying is the end value would have been below 84 cents. Hopefully this helps answer that question. But if not, give me a follow.
That's awesome. Well, I'm going to go to YouTube for the next question. This is from Krishnan, and he's asking, if I already have a position, can I use vertical spreads to hedge my position?
Well, it's possible, like, let's say you're a long stock and you think that there's a possibility that the stock might go down. You could sell an out of the money call spread, right? That gives you a little bit of delta, a short delta. So It's possible to hedge some of your delta risk. Yes. So
Awesome.
it's similar to like doing a covered call spread, right? If you're long stock, you sell a call, you're hedging off some of your risk. So the call spread, what it does is it's similar, but it stops you out. So you're, if you sell a call, the stock goes up and your that call is unlimited, right? The loss is unlimited. With the call spread, you stop out. You stop out your loss.
Great. Back to the questions on our meeting. We have a question that says, instead of credit vertical spreads, and I don't know if this is a screen that the person did, but he's asking, suppose deep in the money debit vertical spreads, one can get 20 to 30% in 1 to 2 months. He's asking for your comments if that's available. And say
it again, for debit call spread, he said?
He said he's looking at credit vertical spreads. So he's saying, he's saying instead of credit vertical spreads, suppose deep in the money debit vertical spreads can get you 20 to 30%. So I guess
so that would exactly. So this would just be the mirror, like it would be similar to this, except you're doing, so let's do a call spread, right? Let me go to a call spread. So this is what you're looking at is like a deep in the money call spread. So I'm going to do the same thing. I'm going to look at next 30 days, right? And let's just look at this theoretical edge. Let's put it at least 10%. Could do like, let's do 70%. I'm just going to use the same filters as last time to make it easier. And you're looking for deep in the money call. So I'm going to use this best downside cushion because that's what you're really interested in. What you're interested in is it's deep in the money, because that way the stock, has further to drop before you start losing money. So here's what these came up with. So I did put in at least 10% edge. Let's put any positive. Let's just say it doesn't matter the edge. I'm more interested in like the cushion, 6.5. So here's your deep in the money. So here's like 170, 175 call spread, right? That's deep in the money, 6.5. So if you're buying for 475, it's worth $5. At the end, you made 25 cents. That's a 5% return. Here's a 22% return, 20% return. So that's, actually, he was asking for a 30% return. Is that what he said?
Well, he said 20 to 30%.
So that's it. Yeah. Or you could even do it here, 20%. Here, 25%. Let's see if anything pops up. So this would be like a deep in the money call with at least 25%. So here's a 26%, 30%. Obviously, it's not going to be very deep in money, but 180, 177.5, 182.5. Call spread for Microsoft 186. So that's how it goes.
Great.
Yep.
Next question is from Stephanie. She was asking, where was that question? Oh, she was asking about the proximity to earnings. She's worried that can affect the spreads. Is there any way within the screener she's asking to back out the earnings?
Yeah, so you can back out. So whenever you see this little E, that means that this spread here is going to cover an earnings event. You could just back it out and just say, show me.
Hey, D.
Yeah.
Your audio seems to be bad. You want to refresh real quick and maybe come back in, or?
Okay, my audio is bad, you're saying?
Yeah, your audio sounds scratchy, like you're breaking up.
You mean like exit the meeting and come back in?
Yeah, maybe just refresh. Yeah, just hit refresh.
Actually, let me just see if can I refresh it from here?
Yeah, you just hit the refresh button. While Dimitri's doing that, everyone, just so you know, next week on Sunday, we're going to be having our webinar series, and we're going to be having Dan Passarelli from, I think it's Market Taker Mentoring will be on. And he's a super interesting guy, an old CBOE trader. And a very interesting person in the space, and he does a lot of webinars, and so we'll have that going on. How's my sound? Is my sound all right? We're also always open to, and I'll put the email in the chat. We're always open to ideas for webinars. So if anyone has an idea for a topic they'd like Dimitri to discuss, we'd love to do it. We're also thinking about, you back?
Yeah, how does it sound?
Oh, it sounds pretty. How's it sound to everyone else?
All right.
Let me know in the chat.
Thanks. All right, so yeah, just let me know what the next question is. If I have to share my screen, I'll just.
Well, I would just show, I think we were on Stephanie's question. If you just show her, she wants to do a screen, but back out earnings.
Okay, yeah. So let's do that.
So I just put support at Market Chameleon in there. Send us any ideas for a webinar series, and we will put it on a Sunday show. All right, go ahead, Dima.
So in this trade, like over here in Alibaba, this expiration, you know, it's going to cover an earnings event. Like you can see that little E there. But if you just want to filter them out, just say earnings dates after expiration, and it'll just filter those out for you. But one thing we do is, like, if it's earnings, you could also see if there's any other events, like that little C is telling you there's going to be in Visa, there's going to be like a JP Morgan conference. You could filter those out as well. But if there is an earnings event, the machine switches and actually calculates historical returns around earnings. So it does put in, it does compensate for the earnings events. But if you don't want to do the earnings events, yeah, just use this filter here, earnings date, and just filter it out.
Awesome. Yeah. I hope that answers your question, Stephanie. We had a couple questions on YouTube. Let me bring those.
Okay.
Want to get to someone's asking about the liquidity of an option. I know it's a simple question, but he's wondering if there's a way to find out how much, a liquid option versus an illiquid option.
So the way this scan is working, because I think there's two things about illiquid options. First of all, it's like the width of the market, the bid-ask spread, and also just the size of the market. Because if you have a narrow bid-ask spread, but the size is like 10 up on each side, that once you do a trade, it'll start widening it out. So the liquidity is like kind of like two parts. It's like how much volume is on the bid and offer, and then the spread, how narrow the spreads are. Now, you can create your own watch list and just do your own watch list, or you could just like do, stocks with, high market caps, or, a lot of average daily volume. But one thing that I do is, like, if you pick out the spread, and you could just click on here, like you see where I am right now on that June 5 expiration, it's blue. Yep. If I click on it, it's going to automatically take me to the options chain, so I could do further analysis on it. And there I could see the markets and get like a better visual of what's going on. So here it populated that spread for me. I'm on the options chain, it's June 5th. So it's saying buy June 5th, 177 call, sell June 5th, 182.5 call. And I'm going to run that strategy here. And this kind of tells me, and this is actually important, it's a good question, because now that we got the strategy set up, right, and this is a debit spread. So here it's saying if I bought it on the offer, it'll cost me $3.95. But you see here that the bid-ask spread, it's pretty wide, 50 cents. That midpoint is $3.70. So whenever you bring up an option, on your broker or spread, you want to get it as close or better than that midpoint, because the further you go away from that midpoint, right, the more it's like that's your fee, right? That's your fee that you're paying to execute that trade. So just because the market's 345, 395 doesn't mean you have to pay 395. You want to put a limit order and try to do better. There's no rule that you have to pay the offer. So you want to kind of get, once you find that trade that you like, you want to kind of look at that liquidity, and it could always change, like it's been changing. Sometimes it widens, sometimes it narrows. So you kind of want to take a look at that, but pay attention to that midpoint. The midpoint is kind of considered the immediate fair value for your execution, right? That's kind of what it's considered. That's where it's going to get marked. So if you bought it, let's say for 380, the midpoint's 370, your broker is going to say you lost 80 cents right off the bat because it'll get marked at the midpoint. That's how options get marked.
Excellent. We have a question about calculating edge. The person's asking, what option pricing model do we use to calculate edge? I guess, how is edge calculated?
Right. So I just showed you an example of using actual returns, historical distribution of returns. You have the option, though, you could take, like, say, from the options chain over here, you could create theoretical value, using all these different, this is using the binomial. So if you wanted to just like input an implied volatility, you could input an implied volatility here. Say, I think implied volatility is 22, right? I'm going to use a custom, press OK. And this is going to use the binomial option pricing model. And here in the middle, it's pricing it based on whatever input you put in there. And then you could compare that to the prices. So it's up to you if you want to use the actual returns, which you can. You could also use the binomial model. And if you already have an idea of what a volatility you use, or for convenience, you could actually just use like last 20 days volatility, 1 year volatility, just by clicking on it, the average of the two. You could also use the median. What is the median implied volatility? In other words, in the last year, what is the middle value of the implied volatility? You could do that as well. So you have a lot of different ways. There's no like one right model, right? There's no such thing as one right model. It's kind of like you're using a model to see how far away it's deviating from that model.
Excellent. Someone's asked, excuse me, there was a period you were talking about looking at support, certain features that people look for in stocks. And They were asking about, is there something with overbought and oversold? I don't know if that was something that maybe they saw in a drop down. Is there anything there?
I mean, people use the RSI for overbought, oversold. I mean, we don't really have an overbought or oversold indicator like that. I think you could get like in the stock screener, you could kind of, if you go to the stock screener here, I think we have like a, let me see here. Here's like an RSI here where people put like overbought or oversold, right? This is using like a technical, it's just the regular technical indicators of like an RSI. So you could use that. Some people use it, some people don't. But
that's perfect.
Yeah.
Someone's asking, when credit spreads are discussed, is the credit actually not realized until the position is closed out?
Well, yeah, exactly. It's kind of like, because you don't know what you're going to have to, what's going to happen to that position until it expires. You might have to buy back, and you might have to buy back for more than you received. Then you're going to be at a loss. You might have to buy it back, but maybe you sold it for $1 credit, you bought it back for 50 cents, then your profit's only 50 cents. So until that positions run its course, until they expired, you don't know what your actual profit or loss will be. So there's no realized gain until those options are, until you either close out of that position or until expiration, when they all go to parity.
Great. This is from
but that's a good question, because I think somebody actually asked me that, like, well, if I do a credit, do I just keep that money? No, you received something, but you still have that risk on.
Good point. Do you want to take a quick look at Cisco? They're reporting earnings this Wednesday. I know it's kind of off topic because we're talking about credit spreads, not earnings calendar, but someone's
Okay.
asking, Cisco's reporting earnings on Wednesday.
Okay.
Is there anything the Chameleon is showing?
So I don't want to get too much into the let me just see the.
I just thought it'd be interesting to show that piece of the
Uh,
Chameleon.
yeah, I think that. Let me just see. I mean, there are a lot of tools around earnings. The thing is, I don't think I could answer that. Like right now, nothing's like popping out at me, but I don't think I could answer that in a minute. And I'm like,
Yeah, there are no big alerts popping. I got you.
yeah, there's no big alerts popping out.
Here we got one from Ron. You mentioned that low delta options can be punishing when it comes to losses. Is there a study that shows most optimal sell delta in a credit vertical spread?
Well, like I said, I don't think there's like an optimal delta because a delta is just a function of the option price. Okay, so if the option price is priced too low, the delta will be low. If the option price, is high, the delta might be. So there's no optimal because it's by delta you can't do it, right? It's like it's a function of implied volatility, the option price, and I don't think there's an optimal delta to do it. You have to kind of like look at the markets at that moment and make a decision based on like how are these priced, right? How are these options priced, and are they priced too high or too low? And the delta won't tell you, right? Like if the option deserves to be $1, right, and it's 5 cents, your delta will tell you there's a very low probability that it will be like whatever, almost no delta. So the delta is not going to tell you everything. Was that the question? It was about
Yeah,
delta,
no,
right?
that's it. Yeah, that's
Yeah.
it. And what is optimal, right? I mean,
Yeah, it's like exactly what is optimal. I don't think there's an optimal delta. Although our naked put screener, if you here's here, let me show you something. This is a different type of study over here. This is a naked put screener, and what this does is actually look at if you continuously, right, like here AMC here, I'm just going to isolate this, right? And here, what this is saying is, here's a study and said that if you continuously in AMC sold a 49 delta put, in this situation it's put, 49 delta put with the same days to expiration, right? This is telling you how you would have done. So all you did was every time the option expired, you would do the same thing, just sell the market price, whatever this 49 delta put is, you would just sell it. Okay. So this is what this is telling you, that you would have made money 71% of the time in this situation, but your return, your average return was zero. You actually you did this 38 times and you lost. You didn't make money. You didn't lose. You didn't make money. It's zero, right? And here it's telling you that if you just did the stop instead of the option, if you just did the stop, reset the stop for that same period, your win rate was 57.9%. So you won less frequently, right? If you did it with the stock, you won less frequently, but your average return was positive. So here, the stock only beat selling the put, right? So this is a study kind of like what you asked. What if I just did the delta? Well, in this naked put, it's showing you, if that's your strategy, just pick the delta, here's a 16 delta. So here, 80 historically out of the last 37 times, here you can load it, and you could see this is the study, it shows you what the put price was at the time, 4 days to expiration, and what the stock did, what the put did. Here, 86.5% of the time, you're a winner. Remember, the frequency of win was great, 86.5% of the time, but this is your return. This is your total return, negative return of negative 0.2%. That's why I say here's a 16 delta. And that's, if you're looking just at delta alone, it's not enough.
That's words to live by. We should get that on a t-shirt.
Yeah.
We are over an hour in, Dimitri.
Okay.
I know I have homeschooling to do. You still homeschooling your kids?
But, yeah, well, they do their work. I just kind of check it, and like a lot of times they don't even need my help anymore. Like, I just kind of monitor their grades. So they're kind of good with that. Used to always do homework with them, but now, knock on wood, they've been good with that.
That's great. I've got to go in and check them and make sure they've done it. It's like big bad principal coming in. Hey, listen, everyone. Thanks for joining us today. We had hundreds of participants, lots of great questions. Remember, email us at support@MarketChameleon. Any ideas for episodes in the future? We're going to try to do something every Sunday. Next Sunday, we have Dan Passarelli on. That's someone you've talked to quite a bit, right, D?
Yeah, he was interesting because we get a lot of his students come to us, and I talked to some of his students, and he's more like an earnings trader. He, I think, does exclusively just earnings trades. So because I've heard a lot from his students, I was like, okay, well, why don't we bring him on and like see, see what he does.
Yeah, no, it's going to be great for our chameleon community. I mean,
yeah.
He's an ex-CBOE guy, has a very interesting background. I know he runs seminars all over the world. So he'll be on next Sunday, and we'll be able to talk to him and pick his brain and let chameleons ask questions. Cool. So, Dimitri, great job as always.
Thank you, Will.
Dimitri is very knowledgeable. I mean, is there anyone better than Dimitri? I mean, some great accolade. No, that's not from me. Nice. I mean, I believe I do say that quite a bit, but this is coming from people on the chat, which is always nice.
Thank you, everybody. Thank you. Really appreciate it. And I really appreciate all the emails. I get to talk to or try to talk to as many people. Nowadays it's a lot of people, so I don't get to talk to as many, but I try to, and I try to share whatever I learn from people or conversations. I try to share in the webinars.
Yeah, no, it's great. Just so you know, for the poll, everyone, 75% of you, it was over 50 have traded credit and debit spreads. So only 25% had not. So interesting poll. It was a great episode. We look forward to seeing you all or hearing you all next Sunday. And, happy belated Mother's Day to any mothers out there. I know Stephanie was on. We had quite a few ladies on and maybe moms. So it was cool. It was a good show, everybody. Thank you very much.
Thank you, everybody. Stay safe.
All right. Be well. Safe trading week, everybody. Bye-bye.
Bye.